Good afternoon, everyone. We are the masters from the FinMan First Term MBA program, and today we're diving into one of the most fundamental concepts in corporate finance, the cost of capital. So what exactly is the cost of capital? Simply put, it's the cost a company incurs to raise the necessary funds for its business operations. You can think of it as the financing cost, the interest rate the company pays when securing a loan, issuing bonds, or using equity financing. This cost is typically expressed as an annual interest rate, say 5% or 10%. It has two key applications. Financing cost, it's the annual percentage cost of debt or equity. Investment hurdle rate, it represents the minimum rate of return a company must earn on an investment to consider it profitable. If a project's expected return is less than the cost of capital, it's not a worthwhile investment. Crucially, this cost is calculated as the weighted average cost of capital, or WACC, which factors in the cost of debt and equity based on their proportions in the company's capital structure. Why do we spend so much time calculating this number? The cost of capital is vital because it drives three major areas of a company. Investment decisions. Companies use it as a screening tool. If a project's expected return is lower than the cost of capital, the project is not financially viable and should be rejected. Valuation. It is a key factor in determining a company's overall value, serving as the discount rate in many valuation models. Risk management. It provides a minimum required return for all investments, helping management assess and manage the risk associated with its capital structure and projects. Let's focus on the key metric, the weighted average cost of capital, or WACC. WACC is the arithmetic average of the capital costs, where the contribution of each capital source, debt and equity, is weighted by the proportion of total funding it provides. It's typically expressed as an annual percentage. It's important to remember that there is no universal safe WACC. The ideal rate depends heavily on the company's industry, its specific risk profile, and its growth stage. However, as a general rule, a lower WACC is better, as it signifies a lower cost to raise funds. For most mature, efficient companies, a WACC below a certain threshold, like 10%, is often considered favorable. To calculate WACC, we need 5 core components. Cost of equity, R sub E. This is the return that shareholders demand or require on their investment. Cost of debt, R sub D. This is the interest rate the company pays on its debt. Crucially, this cost is adjusted for the tax-deductible nature of interest payments. Weight of equity, E over V. The proportion of the company's total capital that comes from equity. Weight of debt, D over V. The proportion of the company's total capital that comes from debt. Tax rate T, the corporate tax rate, which is used to calculate the after-tax cost of debt. The WACC formula essentially puts these pieces together, weighting the after-tax cost of debt and the cost of equity based on their market proportions. Let's walk through an example with Kwek Corporation to see how this works. They have $6 million in debt and $4 million in equity. The cost of debt is 6%, and the cost of equity is 10%. The corporate tax rate is 20%. Step 1. Calculate the weights. Total capital is $10 million. 6 million debt plus 4 million equity. Weight of equity, E over V, is 40%, 4 million over 10 million. Weight of debt, D over V, is 60%, 6 million over 10 million. Step 2. Calculate the after-tax cost of debt. We use the formula R sub D times 1 minus tax rate. 6% times 1 minus 0.20 gives us an after-tax cost of 4.8%. This is the true cost of debt for the company. Step 3. Apply the WACC formula. We multiply each weighted cost and sum the results. WACC equals weight of equity times R sub E plus weight of debt times after-tax R sub D. WACC equals 0.40 times 10% plus 0.60 times 4.8%. WACC equals 4% plus 2.88%, which results in a WACC of 6.88%. What does this mean for Queque Corp? It means the company must earn at least a 6.88% return on its investments to satisfy all its investors, both debt holders and equity holders. The question on the slide is 6.88% acceptable? That leads us to our next slide. Determining if your calculated WACC is good or bad requires context. Here are the 3 ways to assess it. Compare to industry peers. A company's WACC is most meaningful when compared against its competitors in the same industry, as this accounts for similar industry risks. Use it as a benchmark. This is the primary internal use. The WACC serves as the hurdle rate for evaluating potential projects. If a project's expected return is higher than the WACC, it's a worthwhile investment. Understand the implications. A high WACC suggests the company's capital is expensive. If the WACC is higher than the company's actual rate of return, it is a serious problem. It means the company is paying more for its capital than it is earning from its investments, which is financially unsustainable in the long run. In the first part of our presentation, we define the cost of capital and WACC. Now we'll dive into the individual components that make up that weighted average, starting with the general concept of cost of borrowing. The cost of borrowing is the total amount a debtor pays to secure a loan and use the funds. It's a comprehensive figure that goes beyond the simple interest rate. Specifically, the cost of borrowing includes financing costs, like interest payments, other loan-related expenses, such as loan origination fees, loan account maintenance fees, and borrower insurance fees. When a debtor repays a loan over time, the relationship is defined by this equation. Total payments equals repayment of loan principal, cost of borrowing. Let's illustrate the total cost of borrowing with a loan example. The borrower is seeking a loan with a principal of 100,000 pesos. The loan has an annual interest rate of 6%, an amortization time of 10 years, and payments are made monthly. Crucially, it also includes an annual borrower insurance premium of 25 pesos, calculating repayments and interest. Based on these properties, the loan calls for 120 monthly payments. That's 10 years times 12 months. Each payment is 1,110 pesos. Now, let's look at the total repayments over the life of the loan. This is 120 payments multiplied by 1,110, which equals 133,224 pesos. To find the total interest payments, we simply take the total amount repaid and subtract the original principal amount borrowed. 133,224 total repayments minus 100,000 pesos equals 33,224 total interest payments. This 33,224 is the first and largest component of our total cost. However, the cost of borrowing doesn't stop with interest. We also have to consider various fees and charges that lenders impose. These are often the hidden costs. In this example, the borrower also pays for several additional items. Loan origination fee, a one-time charge of 200 pesos to process the loan application. Account maintenance, this loan charges 600 pesos for account maintenance. Borrower's insurance fee, since the annual premium is 25 pesos. And it's a 10-year loan, the total insurance cost is 250 pesos, 25 pesos times 10 years. Finally, to find the total cost of borrowing, we sum up all of these components, the total interest and all the other fees. Total interest payments, 33,224 pesos, plus loan origination fee, 200 pesos, plus account maintenance fee, 600 pesos, plus borrower's insurance fee, 250 pesos. Adding these up gives us a total cost of borrowing of 34,275 pesos. The key takeaway here is that the annual percentage rate, APR, is not just the simple interest rate. The true cost, or the total cost of borrowing, is the sum of all interest payments plus all associated fees and charges over the life of the loan. For a finance student, it's essential to analyze a loan using this comprehensive approach, as it gives the borrower the most accurate picture of their financial obligation.